of Kotak Investment Advisors, a very good afternoon and a warm welcome to everyone who has joined us today for this post RBI monetary policy webinar. Today's policies announcements come at a time when we are seeing high volatility in financial markets. We are seeing a global sell-off in equities, a weakening dollar index, and easing of government bond yields. And this is happening in the backdrop of multiple confrontations on the geopolitical front. Uh, RBI today maintained status quo on policy rates, with the repo rate staying unchanged at 6.5%. Also, there has been no change in the stance of withdrawal of accommodation. 4 members voted in favor of pause, while 2 members voted for a 25 bips cut. And the RBI reiterated their objective of reaching the medium-term inflation target of 4%. With that background, I'd like to introduce our speaker. We have with us Ms. Lakshmi Iyer. As I think all of you already know, she is the Chief Executive Officer of the Investment Advisory Business at Kotak Alternate Asset Managers Limited. She'll take us through the expected impact of today's announcements on bond markets and implications for investment portfolios. Just one final announcement. This is a listen-only webinar. So if you have any questions, please type them in the Q&A box, and we shall take these questions once Lakshmi shares her initial remarks and we reach the Q&A section. Without any further delay, I will hand it over to Lakshmi. Over to you, Lakshmi.
Sure. Thanks, Prashant. Hi, good afternoon to everyone. It is a rainy day, and now it's a little bit bright, at least in Delhi. And I'm assuming, at least when I left Bombay, it was rainy. Now it should be better. But the clouds of uncertainty is not just in the weather and the streets in Mumbai or any part of the country, but it is also there across the global central banker decision making. And why I say clouds of uncertainty is because you are seeing dichotomous trends or multiple kind of trends being adopted by different central bankers, starting with Bank of Japan. After hibernating for over 3 decades, we saw the first rate hike. And imagine, when Kumbhakaran wakes up, the kind of havoc that he created, to his counterparts or to his opposition, when Bank of Japan woke up, it meant almost $5 trillion worth of wealth destruction across the globe. And not just in Japan, as you all know that, Japan has been, grappling with low interest rates for decades together. And when that starts unwinding, because we saw how the yen actually moved almost 15 big figures, and the chaos is something which has still been palpable. Bank of England has cut rates. Is it too relevant for us? May not be too relevant. Bank of Canada cut rates. US is now talking about rate cuts. It's not that US was not supposed to cut rates, but November is where there is the election outcome in the US. So the expectation was somewhere around October is when they will try to, bite in the bullet and do a token rate cut. But looking at two mixed data trends, one is obviously the labor market over there, which is showing a significant cool off. And another very interesting thing is, which I put out, I don't know if I put it out on Twitter or I said it on my broadcast list today. If you look at the cohort of 18 to 29-year-old, which is the youngsters in the US, the auto loan and the credit card delinquencies have started really shooting up. The student cohort, as you are aware, this batch which is graduating in between the 3 months back and now, that cohort is incrementally not finding opportunities because IT sector is slashing jobs. Financial sector is not hiring gung-ho. So amid all of that, the probability of recession has increased from 15% to 25%. Now, one can say 25% is not anything to really worry about. I agree, with that view. I'm not saying that that's something which we need to be overtly concerned about, but there will be political compulsions in our mind for US also to act. So, in a nutshell, what we are seeing is that there is clearly some global dangle going on. The only difference is that the akhadas are very different, which is the wrestling rings. And wrestling is very topical right now. So I was just trying to get some analogies to that. It's very evident that the arena in which each of these countries are operating is very, very different. And that is exactly what we saw in today's policy. Whereas Prashant rightly alluded to, we saw the status quo was maintained, no doubt about it. Again, it was 4:2. People started wondering that if it will be 3:3, then what happens? And the three, MPC members, this is their last, term. So there were, a lot of such speculations happening. And more importantly, given what has happened in the last 2 weeks, there was this very small section of the market which expected some sort of withdrawal of accommodation, morphing itself into neutral. As always, Dr. Verma and Dr. Goyal, Ashima Goyal, they voted for 25 basis a cut and a stance change to neutral. I think two, three things I want to highlight among this entire thing that we saw is in terms of GDP growth, and I think there were no surprises, neither positive nor negative surprises, none of those. But I think a couple of things which the MPC also has been very, very conscious about is that between urban and rural demand, they said that there is rural demand which has started improving. Two sets of data, which obviously RBI tracks and we also track, is the high frequency data. And I mentioned, in the morning also when I was chatting with media, that the high frequency indicators are suggesting a mixed trend. So if you look at auto sales, after a very tepid May and June, suddenly has picked up in July, whereas the other high frequency indicators from a macro perspective is kind of sobering down a little bit. For starters, if you look at the bank credit growth, it has started mellowing down a little bit. On balance, if I look at the two, parts of the scale, the outlook remains to be fairly robust. But the biggest headwinds as we speak right now is actually coming in from the geopolitical tensions and the volatility in commodity prices because of that. And if you notice, this entire geopolitical scenario is fairly fragmented. So I think these are some of the known unknown risks. So we all know that there is something which is brewing on the geopolitical front between Iran, Israel, the ongoing anyway Ukraine issues. But the sum of total parts is something which, fully to appreciate obviously will take some time. So I think that seems to be the single biggest risk today. And given that we are on a very strong footing, I know that inflation last month, which is a June inflation, came in on the higher side. It's 5% plus. And that was a very, very important discussion today, which the governor also had on inflation. There was one news item which is talking about reducing the food prices from the headline inflation by 8 percentage points. Now, for a central banker, therefore, some were debating that, core inflation is at 3.4%. So why are you getting overtly concerned looking at 5%? Well, the answer to that is, if you were the central banker, or any of us were central bankers, how can you ignore 50% of your basket? One can debate that over the past decade, the per wallet spent on food is not getting as much, but then let that get reflected when the index gets reconstituted. I don't think it is prudent for a central banker to jump the gun and look at the core inflation, which excludes such a very volatile component. And why I'm sharing this is because you would have noticed that in the June inflation data, almost 30% plus jump actually came in from food items, specifically perishables. So I think the good news is that FY 2026, the RBI first time gave a target of 4.4%, 4.4%. Now, if I put 4.4% and where the repo rate today is at, which is at 6.5, you actually get a real rate of 2.1%. Now, for some of you who would have read this RBI working paper, which was again very recently issued, RBI is talking about a real rate band in the band of neutral real rate in the band of 1.4 to 1.9%. Now, in this market scenario, assuming we go with the right-hand side band of 1.9 or say 2%, for example, that at that 2% real rate, the maneuverability and the inflation, being at say 4.4 or 4.5, your maneuverability on the rate, which is the benchmark rate, is going to get incrementally very sticky. We are not therefore saying that there will be no rate cut, but the voracious I would say euphoria that you are seeing in the US right now, with the US yields coming off to 3.8. I'm saying that kind of euphoria maybe not really warranted from an India standpoint. So I think that is something which we clearly must note. Yeah, but one can say, you can debate that, oh, why are you taking at 1.9? Why don't you take it at 1.4 or 1.5? Granted, and therefore our view has been long-standing that the first rate easing cycle, if India has to embark upon, assuming US does say 25 next month, our view is that the first quarter, which is Jan, Feb, March of CY 2025, is when you could see. So we are in what, August? October is the next policy, December followed by Feb. So somewhere between December and Feb, very difficult to give you like a precise thing. It'll happen in December for sure or in Feb, but toss of a coin right now. We'll get more conviction as we see some more data points. But I think somewhere towards the fag end of this calendar year, stroke beginning of next year is where the pitch can start. If US cuts rates, we're still of the view that it will be 25, though I know some section is talking about 50 basis rate cut in the US in the September policy. Even if it's 25, I think a case for stance change, which will lead you towards a rate cut, could start probably as early as October. So either it could be an October-December duo, or it can be a December-Feb duo, depending on how incrementally we get worse off on the global front. So I think that is one critical data point that we will track. The second data point is monsoons. In terms of area under coverage across the country, it is less than 50% even today, which has been covered by monsoons. That's point number one. Up until late July, which is third week of July, the monsoon was deficit, -7%. Just in early August, which is we are in 7th, 8th, so till yesterday or till 6th, we are above normal. So I think RBI will only want to wait how August will pan, and maybe some parts of September, because it's too early to rejoice and say that monsoons have been absolutely fine. So I think these are the two key points. Crude oil, are we worried about? Answer is no. $90 in April, down to under $80, so 90 plus down to 80 minus. I think all of those are very positive from a market standpoint. Gold prices have come down. So two of your biggest import items, which have pain points on the current account deficit, have actually shown signs of deceleration. Telecom tariff price hike, I know, could be a potential inflationary threat, but China is right now in a disinflation mode, so that acts as an antidote. So I think to kind of summarize this entire picture, for all of us, we can expect some shocks on the geopolitical front, which is where we need to be mindful of. And RBI seems to be under no duress, come what may. As I said, remember that in this wrestling bout which is happening, the rings are very, very different for every central banker. And therefore, there is going to be no one size fits all. There is not going to be a cookie cutter approach. The rate cut cycle, we said this in the last call, and I mentioned this in the note also, that the rate cut cycles are going to be a shallow one. It's not going to be consistently that once you start, you need to keep cutting. You also need to note that the last rate hike we saw was 18 months back, which kind of ties into our thesis that every rate action, between a cut and a hike or vice versa, typically takes at least 6 to 8 quarters to manifest and go into the other cycle, which is why in a block of 3 years, you can see at least 1.5, if not 2 interest rate cycles. So I think there is no doubt in our mind that with the liquidity management, and that's the point which, I also want to jog your attention to. In the month of July, there was RBI did OMOs. They did OMO sales, by the way. And they did that because they know that FPI money is fairly strong. Maybe some bit of currency also management, could be at play because the foreign investors are pumping in dollars in the country. So that could be one logic. The other thing is in the month of July, there were 18 or 19, I think, 19 variable reverse rate repo auctions, because whenever call money dips below the threshold, that is when you start seeing VRRR. And again, for perspective, in June, we saw one. So again, clearly telling you that liquidity management, and again, this is something which we've been saying for a long time, that liquidity management will happen more through OMOs and VRR and VRRR, not through CRR. And I think that stance, however, right now we are at a comfortable liquidity measure in the system. Household inflation, I think RBI has been talking about that picking up. And with the recent budget, while the budget is not inflationary at all, clearly there is some pockets of a consumption boost that they want to give, which is in line with their narrative of pump priming the economy. But having said that, the consumer confidence has weakened. So I think these are the two I would say counterproductive, I would say forces that play with each other. But from our perspective, whether it is at 6% that we are looking at the repo or at 6.5, the case for enhancing duration in this market also continues. Now, one would ask, why are you saying this? Two reasons or multiple reasons, but the key reasons, as I said, look at FY26. See, policy measures, policy actions will be hinged on future expectations of, and this is what Urjit Patel used to say that, and that is what the central banker is following even right now. So if the future expectation is at 4.4%, just 40 basis points above 4% threshold, I think it's very okay to expect a 6% on the repo rate 12 months down the line. And if that were to be the case, can the 10-year go towards, which is right now at in the band of, say, 85 to 90, more specifically 87, can that pivot towards the 6.5 region? The answer is yes. So therefore, the positive view on duration continues. We believe that adding to your duration. So if you are at 1, go to 2. If you're at 2, go to 4. The gap between the 10-year bond and the 30-year bond has actually widened. What was under 5 basis points has gone up more than 3 times. So if you want the same delta for the limited capital that you're deploying, try to buy a 30-year kind of a bond. It may give you volatility, but from a liquidity stance or a liquidity perspective, it can be as liquid when you go to buy or sell compared to the other, different maturity bonds which are available. Between corporate bonds and government bonds, the preference is clearly for government bonds. If you look at what has happened after the LCR announcement, there's been deep buying which is happening on treasury bills, where the yields have eased by 20-25 basis points, but the CD yields, which is on the corporate bond side or the non-sovereign side, there the bond yields have not batted an eyelid. In fact, they've actually inched up. So clearly telling you that the preferred trade even today, so therefore the spreads are widened. So that preference for trade still remains to our mind. And lastly, between government bonds, which is central government bonds, and state government bonds, again, if the spread stabilizes around 30-35 basis points, given that we, like state government bonds at that spread, and obviously it has a sovereign status of the state, we are comfortable to add on state loans, which will predominantly be a 10-year kind of a maturity or a 7-year duration to your portfolio. So I think sum and substance, liquidity management and literally monsoon management, which is why those cloudy days are required from our market standpoint, and enhancing duration, mindful of the fact that you will have to live through the volatility. But I must share with you one data point which is very pertinent. Consistently for the last 6 months, foreign portfolio investors are net buying government bonds. And this is at a time where the market uncertainty, the global uncertainty has led to them selling equities on a net basis. Of course, this is the last 5-6 day syndrome. I don't think it's going to change very dramatically because markets are not, crashing. Markets are just kind of consolidating and then going down a little bit. So I think from all those perspectives, the FPI demand will continue to form a very, very strong anchor to the bond deals. And therefore, even though, as I said, our duration call, which we've been giving now for almost a little under 4 quarters, little under a year, that stance is vindicated, but we are not yet ready or prepared to change that stance. For those of you who found RBI's narrative today a little bit hawkish, I don't know what word to use. It was not hawkish. It was not dovish. you can say it was, a cautious note, saying that don't party too so soon just because the world is cutting. Like saying that begani shadi mein Abdullah Diwana mat bano. So their shadi is happening in the US. We don't really need to rejoice too much. But at the same time, they are pretty deft in terms of acting. So I think that these are the broad takeaways, today from whatever we've read and understood of the policy. Any views, any other thoughts? I'm happy to chat more on that. I'm fine with that. Or Prashant, if you have any questions which you
Yes.
have.
Yeah. So just a reminder to all our participants, in case you have any questions, you can enter them in the Q&A box. We have, one question which, is tied to the point that you made, Lakshmi, about the supply or the demand rather from the FPIs. Now, there is definitely some demand supply mismatch, right? Because with the inclusion of Indian government bonds in the JP Morgan index, this has led to a higher demand, which was not, present in the past. This is in a way coinciding at a time when government borrowing has been limited, and this has led to a lower supply of bonds. So do you think, this demand supply mismatch can lead to further softening of yields even before, any explicit easing happens from RBI?
Yeah, so yesterday somebody was chatting with me, actually, one of the journalists only, and they were asking me a very similar question that can you see a crunched spread gap between repo rate and the Indian 10-year? Well, we've seen that in the past. It's not that we've never seen that. So expectations start getting discounted ahead of its happening. And to your point, as you rightly alluded to, the strong catalyst today is the FPIs, who are durably buying anywhere between $2.5 to $3 billion on a monthly basis. Now, just imagine what did the $2.5 $3 billion SIP tsunami do to the mutual fund, do to the equity markets. So every time the FPI is selling, so yesterday's data is clear, pudding, proof of the pudding, that the 9,000 odd crores that FPI sold, that got more than compensated by the 10 odd thousand crores that DIIs or the domestic institutional investors bought. So I think, yes, there will be a strong anchor. We could see the narrowing of spread between the Indian 10-year bond and the repo rate, given the fact that there could be a lag between repo rates being cut and the yields softening could probably precede a rate cut, given that expectations right now are fairly positive.
Sure. Uh, we have the next question from the Q&A section. What is the probability that Indian yield curve will steepen, wherein RBI cuts repo by 50 to 75 bips, but 10-year and 30-year yields do not move lower?
So, at this juncture, I would assign a very low probability of an yield curve steepening. As I said, the reasons being that there is no inflationary expectations which are getting buffered into the yield curve. Typically, the steepening of the yield curve is a harbinger of inflation, which we are not seeing. If RBI will cut, but yeah, the 5 cross 10, probably that spread could see some marginal widening. I will not rule that out because rate cut typically tends to benefit the shorter end of the yield curve quite immediately. But because liquidity is not in the very, very comfortable or cushy zone, that also remains to be, a very elusive kind of a thought. But I think given the fact that the fully accessible route for FPIs has recognized quite a bit of bonds in the beyond 10-year segment, and their anchor remaining, this massive steepening, marginal steepening, I will not do. As I said, the 10 cross 30 at 5 basis points is now gone to 16, 17 basis points. So some bit of that may happen, but out and out widening or steepening of the yield curve, very, very unlikely.
Right. Next question from the Q&A section is the 30-year GSEC is already at 7.03 versus 7.23 months back. How much headroom is left here in terms of investment returns?
So there is headroom left still, because on an annualized basis, the yield is much higher by 14, 15 basis points. As I said, the broad view, the narrative, if the view has not changed in terms of impending rate cuts today on a risk reward basis, I know there is a tad higher duration, no doubt about it, but you don't have any credit risk in sovereign. Therefore, on a risk reward, if you have just like, $100 to allocate, you're absolutely okay if you put a $50 in a 10-year bond and buy $50 of a 30-year bond. Or, if you want to play a slightly wider barbell, you can buy a sub 10-year bond, 5 to 7 years, and go all out, buy a 40-year kind of a bond. But I think there is still some elbow room left. It may not manifest itself really soon, as I said, because markets are still digesting. Some sections of the market, as I told you, were expecting a stance change. So some bit of that consolidation, and it's going to be more of a sideways movement. But yeah, I mean, you're getting those sideways movements, stroke maybe marginal uptick, if any. If US yields will retrace by 10 basis points, you'll get a little bit of opportunity here. So use those opportunities to buy on dips. I think the story still continues to our mind.
Lakshmi, related question, and I think this is, more now from an execution perspective. See, I think the situation here is, for many investors who had not taken the long duration call and are now feeling a little left out. They are now waiting for maybe some bump up in the 10 years before they kind of maybe get back in. Would you suggest them to wait for some level which could be maybe closer to 7%, or would you recommend the investors to go in right now?
It's very difficult to give you precise timing. Honestly, our view is we've been maintaining this for long. You're playing for 40, 50 basis points. And in that process, if you have to give up those 5, 7 basis points, are we expecting a 25, 30 basis points uptick in the moment? Optically, there is nothing, or there is no data point, micro or at the macro level, domestic or at global level, which is suggesting something like that. In fact, the risks are skewed towards having some upside in bond prices, and therefore downward movement in bond yields. Therefore, the next best option would be to tranche it out. So if you have to put $100, put like a one third over the next couple of months in this sideways stroke consolidation, because you get to earn that extra carry also, right? Liquid or overnight funds are yielding you 6/4, 6/2. So that additional 60 to 70 basis points carry on a day-on-day basis also cushions some yield uptick. Unless, of course, you see a sharp bump up in yields. I mean, that's not something you can't plan yourself for exigency kind of situations. We are planning for a probabilistic scenario where we can say with 7 or 8 on 10 certainty.
Right. Recently, we had this announcement or news, which is wherein there was some in the curbs introduced for foreign ownership on the 30-year and 40-year G-Secs. How do you expect this to impact the markets?
No, there's no impact because they just removed 2 securities in that bucket. But there were other securities which were anyways available in that same bucket. So there were two securities in that bucket. They've just removed 1 each in that bucket. So that's about it. So it's BAU. There's no change over there.
Right. How can duration call be played other than GSEC bonds, which mutual funds can be looked at for a 20 to 30 year mod?
Buy long duration funds. I mean, the longest, wherever you see, I think you get every month data. The data should clearly give you a case in point. But go for wherever you have the highest duration. If you haven't yet deployed your money, there will be obviously mark to market on a given day basis. But I think that's par for the course.
Right. One question.
In fact, one point is that apart from law, so there are 2-3 avenues. One is long duration funds, which I just mentioned to you. Their mandate is to be beyond 6-7 years duration. So that's number one. Right. Number two is you can pick up the bonds directly. As I said, they are available, on platforms to be executed. So you can go for that directly. Any ticket size, not a problem. Entry exit. And third, not really explored as much by non-institutional investors. But if you are willing to withstand volatility and you want to delta deploy lesser, you can do interest rate futures. But of course, they are more predominantly available in the 10-year segment, and it's not very, very high on liquidity. But for smaller ticket sizes, even that can be considered. But obviously, the margin top-ups need to be done on a live basis. That's the only small thing, which is very similar to how you do Nifty futures on the equity markets.
Right. Also, Lakshmi, I think, post the budget, investors are revisiting their existing debt mutual fund portfolios, especially some of these older debt mutual funds, which enjoyed indexation benefit, no longer, will have that. On the post-tax basis, when they redeem the tax impact will be higher, and hence the post-tax returns will be lower. These investors are now wondering, which other debt avenues apart from debt mutual funds can they look at? So according to you, in this current market, what would be your recommendation?
We like REITs. You can look at REITs as another, very durable alternative. Typically, if you see, and this is a trend world over, interest rates coming down is very positive for REITs. The DPU, or the dividend per unit, tends to improve. It's a hybrid instrument, so you get the benefits of both scales, and it's tax efficient in this kind of a market. So go for REITs. As a durable alternative, well managed long short strategies, which are absolute return strategies, and they are market agnostic. They're not targeting a nifty kind of a return, but they're trying to look at some debt plus sort of a return. So good vintage kind of money managers, if you have in that space, is something which you should definitely look at. So you can look at good quality credit, credit standalone or credit funds. Even today, uh, unsecured is facing some headwinds, but by and large, the senior secured pools are doing fairly well. So I think these are some of the 2, 3 avenues. I look at hybrid funds, which have, tail end 20, 25, 30% equities. I think these are great opportunities to bump up your fixed income return and yet maintain, the tax efficiency in each of these structures.
Right. Just taking that point on credit, a little further, over the last maybe around, 1, 2 years, we have seen many players, coming in the market and trying to raise credit funds. Do you see any risks that could, this could lead to? Because in a situation like this, there is a possibility of mispricing of risk. So what is your assessment?
Yeah, so your question actually had the answer itself, that mispricing
Yeah.
of credit risk is the biggest risk that I really fear and I'm really paranoid about.
Mm.
15% asset, I fight with you and then you price it at 14, then you fight for an ABC prices at 13, and it is net the underlying investor who finally gets shafted because in a matter of 48 hours, nothing really has happened to the company or its credentials. Underwriting standards in terms of governance, in terms of all of that. I think these are the 2 key risks that I find from an economic standpoint, where we are in terms of the cycle. I don't really foresee too much of macro, headwinds playing spoil sport for this category of funds. Therefore, I think picking and choosing the right kind of manager, if you're looking at a fund structure, or when you are looking at an individual, credit, for example, as an evaluation, make sure that you are, evaluating it from all of these perspectives, because once you misprice a credit, upfront, you are out of money. I'm not saying that you will want to sell. These will not anyway sell. So these are all held to maturity kind of assets. But ab initio, why would you want to get into a raw trade? So I think these are some of the factors, because everybody worth his or her mom and pop is actually launching a credit fund because it's looking to be like an easy AUM gathering sort of a strategy. So I think these are some of the pitfalls that one need to be really, really guarded and be watchful of.
Right. One product category which has seen significant investor interest over the past few months is arbitrage. So when will we see the impact of rate cuts in arbitrage, and do you think it has been already factored in, or it only gets factored post the rate cuts from RBI?
So yes and no, some bit of it you are already seeing, but some bit will also manifest when the actual rate, cut happens and you see the benchmark rates actually gravitating lower. And also add to that, Prashant, we've seen STCG go up from 15 to 20%. So for some of the entities of the investment fraternity, the relative attractiveness, has kind of, diluted a little bit, though it still remains to be durable. From on an absolute basis among the other alternates. We also need to be mindful that some sort of this kind of money can also find its way into money market funds. For example, they have a 1 year duration cap or low duration funds, or fixed deposits, corporate. Fixed deposit, good quality corporates, high pedigreed ones, or bank fixed deposits, because these are all played for, say 3 months to 12 months or 15 months. So the sweet spot of that 6 months, 9 months is where banks also have got very, very competitive. So for those who have, non-individual files, for example, for them, definitely the arbitrage gap has narrowed substantively, making some of these options quite kosher to evaluate from an investment standpoint.
Great. Those were all the questions we had today. Thank you all for joining us today for this webinar. In the meanwhile, if you do have any further questions, please do reach out to your advisor. And with that, we conclude today's webinar. Once again, thank you, and hope to see you in our next post for our post RBI policy webinar. That will be sometime in October. Thank you. Thank you so much.
Thank you. Bye. Take care.